Welcome to Talk Tickers, where we break down the latest earnings calls, and today we are tackling Deutsche Bank's very impressive third quarter.
I mean, just look at this. The stock has been on an absolute tear over the last year, more than doubling in value. We're talking about leaving the broader sector completely in the dust here.
So with a run-up like that, the big question on everyone's mind is this: is the turnaround finally complete? Has this multi-year transformation actually hit its stride for good? All right, let's dive in and find out.
Okay, first things first. Let's look at the headline numbers. And spoiler alert, they were strong, pretty much across the board, and gave the market a really nice positive surprise.
So let's break this down. Deutsche Bank didn't just beat expectations, they absolutely smashed them. We're looking at earnings per share of 89 euro cents. That's a full 25% above what the street was looking for. Revenues also came in hot at 8 billion euros. And just look at that profit before tax, up 8% year over year to almost 2.5 billion euros. A really decisive beat.
And how did the market react? Well, exactly as you'd expect. The stock popped over 4% on the day as all these strong numbers started sinking in.
All right, so those are the numbers. But what's the story behind the numbers? Let's get inside management's playbook and see how they're steering the ship.
You know, CEO Christian Singh came out with a really confident tone on the call. The message was clear. This wasn't just a one-off good quarter. He basically said, hey, we've delivered record profitability for the first 9 months, and we are right on track to hit every single one of our full-year goals.
And this is what I find really compelling. They didn't just talk about the past. They firmly doubled down on their 2025 targets. We're talking a return on tangible equity over 10%, keeping that cost-to-income ratio below 65%, and hitting a revenue goal around 32 billion. And on top of all that, they're planning to return a massive amount of capital to shareholders.
And how can they be so confident about those shareholder returns? Well, it's all built on a rock-solid capital position. Their CET1 ratio, which is that key measure of a bank's health, actually ticked up to 14.5%. That strength is what's funding everything else, including 1 billion euros in buybacks just this year. That's management putting their money where their mouth is, showing real confidence in the earnings power of this bank.
So that strength comes from somewhere, right? It's built on solid performance. So the next question is, where exactly is all this growth coming from? And the story here is really about diversified strength across all 4 of their core business engines.
And management made a really crucial point on the call. Almost 3/4 of the bank's revenue now comes from more stable, more predictable sources. Why does that matter? It means they're way less reliant on those wild market swings. It's about building a much more resilient, dependable earnings machine.
So in the corporate bank, they're really scaling that global house bank strategy, becoming the go-to bank for big global companies. That's driving really strong, steady fee growth. And at the same time, the investment bank is just continuing to fire on all cylinders, especially in fixed income and financing.
And it's not just the investment bank. Over in the private bank, that turnaround story is gaining some serious momentum. I mean, 25 billion euros in net new money this year alone, and a 71% jump in profits? That's huge. And let's not forget asset management, which just keeps chugging along as a super profitable, super efficient part of the business, posting an incredible 28% return on tangible equity.
Okay, so the individual businesses are doing great. But to really get the full picture, we need to put this in context. How is Deutsche Bank doing compared to everyone else?
And the answer is, the outperformance is just stark. Look at this, 110% total return over the last year. That has absolutely crushed the broader European banking sector, which had a decent run at 60%, but it's not even in the same league.
Okay, so that brings us to the big question, the one that really matters for investors. Where does the stock go from here? So here's our take.
All right, after digging through the numbers and listening to management, we are initiating our coverage with an outperform rating.
So here's our thesis. The bull case really hinges on the bank proving it can sustainably deliver that double-digit return on tangible equity. The big date to circle on your calendar is November 17th. That's their strategy update, and it's going to be absolutely critical for the post-2025 outlook. That's where we could see a major re-rating of the stock. So what are we watching next quarter? Continued cost discipline for sure, and any hints about their future capital return plans.
So for our trade idea here, you could think about building a long position heading into that big November 17th strategy day. You're essentially positioning yourself for management to come out with a new, aggressive plan for capital returns. If they deliver, that could be the catalyst that closes the valuation gap with its peers and unlocks that next leg up for the stock.
This is not financial advice.